No gatekeeping. Here's what a stock actually is, explained in detail for beginners. First thing you gotta know is a stock is just a tiny piece of a company. When you buy a stock, you're buying a share, which means you own a small part of that company. You're not running it and you're not making decisions, but you do own a piece of it. And because you own part of that company, you can benefit financially if the company does well. The big question is, how do you actually make money with stocks? There are two main ways. The first is price growth, also called appreciation. This is when you buy a stock at one price, and if you later sell it for more, you keep the difference. Think of it like buying sneakers for $100 and then selling it to a friend for $150. Congrats, now you just made $50. But it can go the other way too. If the only offer you get is $70 for the sneakers you paid $100 for, you'd lose $30 if you sell. The thing is, stock prices don't always go up. When they go down, big losses can happen. The second way you can make money is through dividends. Some companies may share their profits by sending cash payments to their shareholders, which basically means you get paid just for holding the stock. But dividend payments aren't guaranteed. A company may reduce the amount or stop them altogether. Now, let's make this real. Imagine a company called Mango, and they make these super fancy smartphones. Mango is thinking about selling their phones not just in the US. To grow though, they need money, also called capital. They can take out a loan, but that would mean debt, or they can sell ownership in the company to the public, which is literally called going public. Crazy, I know. So let's say Mango needs $1 million to expand. They create 1,000 shares, which means each share costs $1,000 during the IPO or initial public offering. Then this big baller Filippo comes in. Filippo has extra cash, wants better returns than a savings account, and is okay taking on more risk. So what does he do? He buys one share of Mango for $1,000 using an online brokerage. What happens next depends on how the company does. If Mango grows, sells more phones, and generate profits, the company can be more valuable and the stock price can go up. Filippo could sell his share for more than he paid and make a profit, kind of like reselling those sneakers. Just keep in mind, taxes and fees can affect what Filippo can actually make. On the other hand, if the company struggles, the stock price can drop, and Filippo could lose money if he sells. That's why knowing about risk matters, because stocks are riskier than things like savings accounts, bonds, or CDs. But that risk comes with a chance for higher rewards. Smart investors manage risk by having a written plan for their investing, like spreading money across different companies, investing in more than just stocks, which is known as diversification, and learning about strategies for use in all kinds of markets. If you're still here, respect. Financial literacy matters so much, and a lot of us were never taught this growing up, including me. So good job for taking that first step, and see you in the next episode where we'll cover compounding. Bye. Wow, I'm dizzy.